Most people imagine wealth growth as a straight line, a slow and predictable process where more effort simply produces proportionately more money over time. But real financial systems rarely behave in such a linear way. In practice, wealth tends to move slowly for long periods and then accelerate dramatically once certain thresholds are crossed. One of the most important and misunderstood thresholds is the first $1 million, because after that point, the mathematics of money begin operating differently. The strange part is not that wealthy people have more money. The strange part is that the structure of the system itself starts helping wealth grow faster once enough capital already exists. Imagine two investors earning the exact same percentage return every year. One person has $10,000 invested while the other has $1 million. If both portfolios grow by 10%, the smaller investor gains $1,000, while the larger investor gains $100,000. The percentage is identical. The effort may even be identical, yet the outcome feels psychologically completely different. One person sees growth that looks incremental, while the other sees growth large enough to resemble an annual salary. This is where many people begin misunderstanding compounding, because compounding is not only about percentages, it is also about scale. At lower levels of wealth, investment growth often feels almost invisible. Someone investing a few $100s per month may technically be benefiting from compound returns, but emotionally, the process can feel slow and disconnected from everyday life. Market fluctuations may erase months of progress temporarily. Emergencies can interrupt contributions, and inflation can reduce purchasing power faster than small portfolios can grow. The mathematical engine exists, but the scale is still too small for compounding to produce psychologically dramatic results. Once larger asset levels are reached, however, the relationship changes completely. Portfolio growth begins generating amounts of money that can themselves become meaningful new capital. Returns start purchasing additional investments without requiring equivalent labor input. Wealth begins feeding itself. This is one of the most important transitions in finance because the portfolio gradually becomes less dependent on external income and more dependent on internal momentum. This creates an effect similar to a snowball rolling downhill. At the beginning, the snowball is small and difficult to move. Progress requires constant force and results appear limited. But as the snowball grows, the same movement collects disproportionately larger amounts of snow automatically. In wealth building, early capital behaves the same way. The first stages usually require the highest relative effort because savings rates matter more than investment returns when capital is still limited. Later, returns themselves begin dominating the equation. Behavioral economics also plays a major role in this acceleration. Larger wealth levels create optionality, and optionality changes financial decision-making. A person living near financial instability often prioritizes liquidity, safety, and short-term survival because mistakes carry amplified consequences. Someone with substantial reserves can usually tolerate volatility more comfortably because temporary losses do not threaten immediate survival. This changes investment behavior significantly. Wealthier investors often gain access to opportunities that smaller investors cannot easily access, including private investments, favorable financing, lower borrowing costs, better tax optimization, stronger negotiating power, and the ability to remain patient during market downturns. Financial systems tend to reward scale because scale reduces perceived risk. Banks lend more willingly to people who already possess assets. Investors receive better treatment when they appear stable. Existing wealth attracts additional financial efficiency. This creates a feedback loop where wealth generates advantages that increase the probability of further wealth growth. Importantly, this does not mean outcomes are guaranteed or that wealthy individuals cannot lose money. Markets remain uncertain, and risk never disappears entirely. But the structure of modern finance often becomes more forgiving once substantial buffers exist. Mistakes become easier to survive. Opportunities become easier to access. Time horizons become longer. Emotional decision-making becomes easier to control. There is also a hidden psychological shift that occurs after reaching higher wealth thresholds. Before financial stability, money is often connected primarily to survival, stress reduction, and immediate obligations. After a certain point, however, capital begins functioning more like a strategic tool. Decisions become less focused on avoiding disaster and more focused on optimizing allocation, preserving purchasing power, and managing long-term asymmetry. The emotional meaning of money changes alongside the mathematical behavior of wealth itself. This is one reason many financially successful individuals describe the first million as psychologically harder than later millions. The first stage usually requires building habits, discipline, income stability, risk tolerance, and long-term consistency simultaneously while operating with limited margin for error. Early investing often competes directly against rent, debt payments, emergencies, and rising living costs. The system feels resistant because small setbacks create disproportionate damage when reserves are still fragile. After larger reserves exist, however, financial shocks often become less destructive. A market decline may still reduce portfolio value temporarily, but basic stability usually remains intact. This allows compounding to continue uninterrupted for longer periods. Time becomes increasingly important here because uninterrupted compounding produces dramatically different outcomes than constantly restarting after financial emergencies or forced withdrawals. The mathematics behind exponential growth also contribute to the illusion that wealth suddenly accelerates out of nowhere. Human intuition naturally understands linear growth better than exponential systems. If a portfolio grows from $1 million to $1.1 million in 1 year, the increase alone equals $100,000. The following year, assuming the same percentage growth continues, the increase becomes even larger because returns are now compounding on previous returns. Over long enough periods, the growth curve begins appearing almost vertical despite originating from ordinary percentages. This is why wealth inequality can expand so aggressively within systems built around capital ownership. Individuals whose primary income comes from labor are usually constrained by time, energy, and wage growth limits. Capital, on the other hand, can continue scaling independently once it reaches sufficient size. Assets begin generating additional assets. Labor remains important, but eventually capital efficiency starts overpowering labor efficiency mathematically. Technology and modern financial markets have intensified this effect even further because global investment systems allow capital to move continuously through equities, businesses, real estate, bonds, and automated financial structures at enormous scale. A sufficiently large portfolio no longer depends on one source of growth. Multiple systems begin compounding simultaneously. Diversification itself becomes a form of stability that protects long-term momentum. At the same time, this acceleration often remains invisible to outside observers, because most people focus only on visible wealth rather than the underlying mechanics producing it. Someone seeing a wealthy investor earn large returns may assume the difference comes purely from intelligence or effort, while ignoring how scale itself changes outcomes. Once a portfolio reaches certain thresholds, even average percentage growth can create extraordinary absolute gains. This also explains why financial resilience matters so much during the early stages of wealth building. Small interruptions can have enormous long-term consequences because early capital is fragile. High-interest debt, emergency withdrawals, unstable income, or inconsistent investing can delay the compounding curve for years. Protecting the process matters because compounding depends heavily on uninterrupted time. None of this means reaching the first $1 million is easy or universally achievable under identical circumstances. Income levels, geography, health, education, family obligations, economic conditions, and opportunity all shape financial outcomes significantly. But the broader principle remains important because wealth is not merely additive, it's multiplicative once sufficient scale is reached. The strange reason wealth grows faster after the first million is therefore not magic, luck, or secret investment tricks. It's the combination of scale, compounding, optionality, emotional stability, financial access, and uninterrupted time working together simultaneously. Once enough capital exists, the system gradually shifts from requiring constant external force towards generating increasing internal momentum. And in systems driven by compounding mathematics, momentum changes everything.